For centuries, gold was the one thing governments couldn't fake. It didn't rust, it couldn't be printed, and it held the same shine whether you were in London, Cairo, or Beijing. It was the closest thing humanity ever had to universal truth, until governments learned how to steal it from themselves. This is The Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. When people think of a gold heist, they imagine masked thieves, armored trucks, or Hollywood robberies. But the biggest gold thefts in history didn't involve guns or tunnels. They involved pens, laws, and quiet signatures in rooms where no cameras were allowed. Because when a nation manipulates its own gold, it isn't called theft. It's called policy. To understand how this game began, we have to go back to the age when gold wasn't just wealth, it was money. In the 19th century, the world lived under the gold standard. That meant every major currency, the dollar, the pound, the franc, was backed by a fixed amount of gold. If you held a banknote, you could walk into a central bank and demand the metal it represented. It was a system built on trust and discipline. A government couldn't print more money unless it had the gold to back it. But discipline has never been humanity's strong suit. When wars broke out and debts piled up, governments quietly bent the rules. They printed more paper than gold they held, a little at first, then a lot. The gold standard became a golden illusion. The vaults stayed closed. The public believed the gold was still there, and that was enough, until confidence cracked. World War I was the first true global gold heist. European nations desperate for funding suspended the gold standard, confiscated citizens' gold, and replaced it with paper promises. Banks locked their vaults. Gold vanished from circulation. It wasn't stolen by robbers, it was taken by governments to pay for war. After the war, economies collapsed under debt. Currencies hyperinflated. Ordinary people saw their savings wiped out. Germany's mark became worthless. Austria, Hungary, Russia, same story. The only thing that held its value was gold, and that made it dangerous. It exposed the lie behind paper money, so governments decided to control that lie directly. In 1933, during the Great Depression, U.S. President Franklin D. Roosevelt issued Executive Order 6102. It made it illegal for Americans to own gold coins or bullion. Citizens were forced to turn in their gold to the government for $20.67 per ounce, the official price at the time. They had no choice. Hand it over or face prison. Then, just months later, the government revalued gold to $35 an ounce. In an instant, Washington had quietly increased the dollar value of its gold holdings by 70%. Ordinary Americans were robbed, legally. It was one of the most audacious acts of financial engineering in history, and it worked. The gold stayed with the government. The people were left with paper, and the paper's promise, backed by gold, remained intact, even though they could never claim it. It was theft disguised as stability. From that point on, the manipulation of gold became standard practice for governments under pressure. If gold defined the value of money, then controlling gold meant controlling reality itself. By the end of World War II, the U.S. had become the global gold superpower. Europe was in ruins, and America's vaults overflowed, more than 20,000 tons of gold, roughly 2/3 of the world's total supply. It was this dominance that allowed the U.S. to shape a new world order at the 1944 Bretton Woods Conference. Under the Bretton Woods system, every major currency would be pegged to the U.S. dollar, and the dollar itself would be backed by gold, fixed at $35 per ounce. In theory, that meant foreign governments could trade their dollars for gold at any time. In practice, it meant the entire global economy now depended on trusting the United States. The illusion was perfect, for a while. But trust, like gold, is finite. In the 1950s and 60s, America began spending far more than it earned. Wars in Korea and Vietnam, the space race, massive domestic programs. Dollars flowed overseas faster than gold flowed in. By the late 1960s, there were far more dollars circulating in the world than there was gold to back them. Europe noticed. So did Charles de Gaulle, France's president. De Gaulle was no fool. He saw the imbalance and decided to call America's bluff. In 1965, he sent a French warship to New York Harbor, demanding that billions of US dollars be converted into physical gold and shipped back to France. One by one, other nations followed. Tons of gold left American vaults every month. To slow the outflow, the US and its allies formed a secret alliance known as the London Gold Pool. It was a coordinated effort between the US, Britain, and 6 European central banks to artificially keep the price of gold fixed at $35 an ounce. Whenever the price began to rise, a sign that people were losing confidence in the dollar, the pool would dump gold into the market to force prices back down. It worked until it didn't. By 1968, the pressure became unbearable. The pool collapsed and the gold drain accelerated. America's reserves had fallen from over 20,000 tons to barely 8,000. The world's gold was literally sailing away. Then came the breaking point. On August 15, 1971, President Richard Nixon appeared on live television. With a calm smile and reassuring tone, he announced that the United States would temporarily suspend the dollar's convertibility into gold. It sounded bureaucratic. It was, in truth, the most important financial decision of the 20th century. Overnight, Nixon ended the Bretton Woods system, and with it, the last link between money and metal. The U.S. had effectively defaulted on its promise to redeem dollars for gold without calling it a default. It was the ultimate gold heist. The first time in history a nation kept both the gold and the confidence, because while other countries still held dollars, those dollars were now backed by nothing. The gold stayed in Fort Knox, the paper stayed in circulation, and the world kept pretending the system still worked. To maintain that illusion, the U.S. built a new foundation for its currency, not gold, but oil. Through deals with Saudi Arabia and OPEC, Washington ensured that global oil would be priced exclusively in U.S. dollars, birthing the petrodollar system. Nations now needed dollars not for gold, but for energy, and that demand kept the dollar strong even without the metal behind it. The world had quietly traded one kind of backing for another, from gold to geopolitics. And yet, through all of this, the gold never stopped moving. It just moved in shadows. While the public was told the metal sat untouched in vaults, governments continued to buy, sell, lease, and swap it behind closed doors. Every transaction rewritten as monetary operations. Every manipulation justified as stability. It wasn't crime, it was policy. After 1971, gold was supposed to be irrelevant. Money had gone digital, debt had gone infinite, and economists declared the metal a barbarous relic. But power never discards what it can quietly use. Governments didn't abandon gold, they simply changed the story. Instead of anchoring currencies to it, they began manipulating it from behind the curtain. The official line was that gold no longer mattered. But in the decades after Nixon's shock, central banks still traded and lent gold to one another in secret. They called it reserve management. In reality, it was the continuation of the same game, using gold to control markets without ever admitting it. The first big move came in the late 1990s, a time when the world believed globalization and paper finance had replaced old-fashioned metal. The Bank of England, under Chancellor Gordon Brown, suddenly announced it would sell more than half of Britain's gold reserves, nearly 400 tons, supposedly to diversify its holdings. The sale drove global prices to a 20-year low. Within a few years, gold prices tripled. Britain had sold near the bottom. Critics called it Brown's bottom. Others whispered that it wasn't a mistake, that the sale had helped large financial institutions cover short positions in gold, essentially bailing out big players at the expense of taxpayers. Whatever the truth, it marked a turning point. Western governments were no longer hoarding gold. They were managing it, treating the world's oldest form of money as another financial instrument. Meanwhile, the rest of the world was watching. Starting in the 2000s, countries like China, Russia, and India began quietly buying gold again, not for fashion or nostalgia, but for power. They understood what the West pretended to forget. Gold might not back currencies anymore, but it still backs confidence. And in a crisis, confidence is everything. The new millennium also exposed another uncomfortable fact. No one truly knows how much gold any government actually has. Take the United States. Officially, it holds around 133 tons, the largest reserve in the world, stored in places like Fort Knox and the New York Fed's underground vault. But that number hasn't been independently audited since 1953. Every few years, calls for transparency rise. Every time, they fade. The vaults remain sealed, the public reassured with grainy photos and press tours showing bars that could be decades old. Why so much secrecy? Because gold isn't just a reserve, it's a thermometer of trust. If the world believed that U.S. didn't have what it claims, the entire financial system would shake. And trust, once lost, is the one thing no government can print. After the 2008 financial crisis, the narrative shifted again. Confidence in banks and currencies plunged. Suddenly gold was back in headlines, not as a standard, but as a signal. Central banks that once sold their gold began buying it instead. Germany demanded the return of its gold stored in New York and Paris. The Netherlands and Austria followed. Each called it repatriation, but the message was clear. We trust ourselves more than we trust you. By the 2010s, the movement spread. China increased its official gold holdings every month for years. Russia doubled its reserves in less than a decade. Nations that had been locked out of the dollar system, like Iran and Turkey, began using gold in trade to bypass sanctions. It was a quiet rebellion, 1 ounce at a time. The United States, meanwhile, defended the dollar through other means. With gold sidelined, the dollar's real backing became geopolitical power, military strength, energy dominance, and the global banking network that runs through New York. But even that foundation began to crack, because while the West printed trillions after 2008, Emerging economies were diversifying into something no central bank could devalue: metal. By the early 2020s, something extraordinary happened. Central banks around the world bought over 1,000 tons of gold in a single year, the largest accumulation in modern history. And they weren't buying jewelry. They were fortifying against what they saw coming next: another reset. The language had changed, but the logic hadn't. Every empire, when cornered by debt, eventually turns to its gold. Some confiscate it, some reprice it, some pretend it's still there when it isn't. The manipulation now isn't in the vaults. It's in the markets. The global gold price is no longer set by shipments of metal. It's set by futures contracts traded in London and New York. These are paper promises to deliver gold that often doesn't exist. For every physical ounce, there are dozens of paper ounces being bought and sold. This keeps prices stable, or, depending on your perspective, artificially low. It's the same trick the old gold pools used in the 1960s. Control perception, and you control value. Meanwhile, digital currencies, inflation, and political division are eroding the world's faith in money once again. And whenever faith dies, people turn back to gold, not because it pays interest or compounds, but because it doesn't lie. That's why the story isn't over. The new gold heist isn't about governments taking gold from citizens. It's about governments taking gold from each other. It's about nations trying to rewrite the rules of value before the next crisis decides for them. The US still claims to own the largest hoard. Europe still holds substantial reserves. But Asia, led by China, now controls most of the world's new gold supply through mining, refining, and state purchases. For the first time in a century, the balance of metallic power is shifting east, and history suggests that when gold moves, so does empire. When Spain's gold fleets drained away in the 1600s, its empire followed. When Britain's reserves collapsed after 2 world wars, so did its global dominance. And now, as the dollar system strains under record debt, gold is once again whispering a warning. Because if the US can no longer keep the world's trust through paper promises, someone else will try to keep it through metal. The same pattern that began in 1933, governments manipulating gold to preserve control, is repeating on a global scale. Only this time, the manipulation isn't meant to defend the old order, it's meant to replace it. In the end, gold is never just a metal, it's a mirror, reflecting what nations truly believe about themselves. When they hoard it, they fear the future. When they sell it, they believe they can control it. And when they lie about it, it means they've already lost control. Every government that's ever touched gold has tried to bend it to its will. None have succeeded for long. Because gold doesn't obey politics, policy, or printing presses. It obeys physics. It obeys scarcity. And in a world of infinite debt, that makes it dangerous. The great gold heist isn't over. It never ended. It just became more polite, dressed in the language of economics and the rituals of central banking. And the next time you hear a government say, "Don't worry, the gold is safe," remember, it always is, until the day it isn't. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.